Well, good morning and welcome to the Reserve Bank. With me at the table is John McDermott, who's the Chief Economist and the Assistant Governor, and Willie Chetwin, who's Head of Forecasting. The Reserve Bank has left the official cash rate unchanged at 3.5%. Global financial conditions remain very accommodative, but volatility in financial markets has increased in recent months due to the sharp drop in oil prices, continued uncertainty around the global outlook and US monetary policy, and policy easings by a number of central banks. The domestic economy remains strong. Falling petrol prices have increased households' purchasing power and lowered the cost of doing business. Employment and construction activity are strong, net immigration remains high, and monetary policy continues to be supportive. The housing market is showing signs of picking up, particularly in Auckland. However, a number of factors are weighing on domestic growth. These include drought conditions in parts of the country, fiscal consolidation, reduced dairy incomes, and the high exchange rate. A substantial downward correction in the real exchange rate is needed to put New Zealand's external accounts on a more sustainable footing. Annual CPI inflation is expected to fall to around zero in the March quarter and remain low over 2015, reflecting the high exchange rate, low global inflation, and the recent fall in petrol prices. Inflation expectations appear to have fallen recently, and we will be closely monitoring the impact of this trend on wage and price-setting behaviour, especially in the non-traded sector. Monetary policy remains focused on ensuring inflation settles at 2% over the medium term. Our central projection is consistent with a period of stability in the official cash rate. However, future interest rate adjustments, either up or down, will depend on the emerging flow of economic data. So thanks very much. Happy to take questions. Yeah, Brian?
Governor, on these projections, in 2 years' time, we will have had 5 straight years of inflation below and often well below your 2% midpoint target. At what point are we entitled to conclude that policy has been too tight and question compliance with the policy targets?
Well, it's been below the midpoint for some time, as you say, and it's projected to start moving back after the oil price effects start to wash through, to start to move back towards the midpoint over time. I mean, the main reason why inflation has been below the midpoint is primarily because of the high exchange rate or the inflation in the traded goods sector. Tradables inflation has been negative now for 3 years, and it's due to many factors. It's due to low overseas inflation, if you like. It's due to exporters cutting prices to maintain market shares and exporters in those economies. It's due to falling capital goods prices, and it's due to our high exchange rate. So all of that has contributed to negative tradables inflation. If you look at non-tradables, it's been running at around 3. It's fallen to around 2.5, which is above the midpoint of the range. And we expect it to gradually pick up over time as the output gap is expected or forecast to increase. So I think there's sound reasons why we've been below the midpoint, but we see future inflation heading towards the midpoint again as the oil price effects work through the economy.
bank informed about the 1080? Did it have any bearing on your decision?
We were informed about 3 months ago, or when the letter became known to Fonterra and then to Federated Farmers. Around that time, we were informed, and it had no effect on our monetary policy decision.
Gunnar, market pricing's outside, they've got priced in an outside chance of a rate cut. Are you comfortable with that pricing? And also, did you consider cutting the rate today?
We looked at, we have a long discussion, as you'd expect, about where the economy is and what's the appropriate monetary policy setting. And it's true that probably I think about 18 central banks have cut interest rates since early January. 7 of those, I think, are in the advanced economies. But our situation's really quite different. I mean, many of those economies are struggling with low growth, or they have large amounts of excess capacity or high and rising unemployment. We're in a different situation. I mean, we've got an economy that's growing at around 3.25%, perhaps 3.5%. We're projecting it to continue to grow at those sorts of rates over the next 2 years. We've got a positive output gap. We've got strong employment growth. I mean, I think employment growth over the last 12 months has been around 3.5%. We've got record levels of net migration, running currently, I think, at around 48 to 50,000. We've got record levels of participation in the economy. They're at historic highs of around 70%. So our situation's quite different from a lot of those other countries that have changed monetary policy or cut interest rates. The cost of capital here doesn't appear to be a major constraint for business. And when we look at the stance of monetary policy, we still believe that monetary policy is expansionary. And at the same time, we've seen falls in fixed-term interest rates. So we were weighing up all these things. We clearly had discussions about what other central banks are doing and why are they doing it, and is our situation different? We see inflation falling to zero on an annual basis in the March quarter. Now that's due to the impact of oil prices. I mean, it has an impact of about 0.9%, so it drives it down to zero. But it wouldn't make sense to actually try and offset that in any way through monetary policy. It's a relative price effect. It's already out there. We focus on monetary policy in the medium term, and that's because monetary policy essentially affects inflation through a 12 to 18 month lag. And the policy targets agreement, in fact, recognises that. It basically directs monetary policy to focus on medium-term trends in inflation when faced with price level shifts of this sort. The key issue for us, I think, will be to what extent does wage and price setting behaviour change in the economy. That's the most critical thing. What we've seen with various measures of inflation expectations is that they've fallen to around 2% since 2013, which is good because that's consistent with the medium-term inflation target that we're aiming at. The issue will be, will wage and price setting behaviour moderate further, causing inflation expectations to fall? And if that did, and we were assessing that to be something that would be sustained over time, then that's something that would certainly affect our thinking on monetary policy. But it's a long answer, but it is a really important question because it's a topical question, and we've seen other central banks moving. So we did think about the issue very carefully. But let me ask John if there's anything that he wants to add or reinforce.
Perhaps I can only reinforce any key points. But I mean, the key issue right now is we think we've got the policy settings right to keep this economy growing, and that eventually that will bring inflation back on track. But what we have to be incredibly vigilant against is a change of pricing behaviour that would not be consistent with inflation at 2%. So that's the key focus that we're thinking about.
How much of what sort of bearing was the Auckland housing market we wanted to have in your thinking? There will be some people who say this is you not wanting to pour fire on a potential bubble scenario.
We're concerned about the Auckland house prices for financial stability reasons. But when you look at Auckland house prices, they're currently running at on a 3-month moving average basis. They're running at an annual rate of around 13%. Now that's in the 3 months annualised, if you like, or the 3 months on an annual basis to January. I think the Rhines data is probably out today or tomorrow. But you're not seeing what the sorts of wealth effects feeding into consumption that you were seeing in 2006, 2007. I mean, we're seeing quite strong consumption growth in the economy, but a lot of that's because of essentially employment growth. Employment growth is around 3.25%, 3.5%, so that's leading to strong income growth, therefore, and that's feeding through into consumption. We don't appear to be seeing the sort of behaviour that we saw in 2006, 2000 and 2007, strong wealth effects feeding into consumption. So, the Auckland housing market we're concerned about for financial stability reasons, but it didn't affect the way we thought about monetary policy.
And can you just elaborate a bit more on whether you're going to do something about that for financial stability reasons?
Well, we haven't made any decisions on that. We're certainly discussing it internally about the Auckland housing situation. I mean, what we have done is we've moved in terms of putting out a consultative document in terms of what are the appropriate asset classes, or what's the amount of capital that banks should be assigning for investor lending for housing purposes. That if you look at default histories or loss histories, if you like, in times of house price declines, albeit often quite sudden house price declines, that if you look at the international evidence, the default rates seem to be higher than what you see for owner-occupied housing. And the Basel Committee has made recommendations that this should be put in a separate asset class. So we're keen to do that. We're consulting now on the appropriate definition of what is an investor lending. We're doing that for macro-prudential reasons because we think that's the appropriate prudential setting for banks in thinking about the exposure to investment-related housing lending. We haven't, as I said, made any judgments or decisions on macro-prudential.
Have you talked about the sort of income ratios such as the Bank of England have
Yeah, we've had discussions internally on those sorts of things. We've had, there's a tool of indicators in the memorandum of understanding that we have with the Minister of Finance, and there are things like counter-cyclical capital buffers or sectoral overlays in terms of risk weights for housing and or things like that, or types of lending. We talk about those as possibilities. We also look at what other countries have done, Ireland, England, but we really haven't made any decisions on this.
So no decision, but can you give New Zealanders a sense of how close you might be to having to take that step?
Not at this point. We're still having internal discussions. Did you want to add anything, Grant? Or? No. Okay.
Given the flow of economic data so far, would you say the risk of a rate adjustment is evenly balanced at the moment, or do you see a bigger risk of either a cut or a rise?
Well, we think the statement that we've put out is neutral, and we've certainly tried to be as transparent about that as we can. So essentially that. I mean, we're going to be looking at the data very closely, as you would expect, and I don't want to repeat myself about inflation expectations, but clearly we'll be looking at all sorts of data relating to wage and price pressures and inflation expectation surveys.
Also, on the currency, given what the New Zealand dollar is trading against the Australian dollar and other currencies, do you think we are coming closer to a time where the Reserve Bank might have to act in the markets, or?
Well, we tend not to look so much at individual, cross rates. I mean, we don't ignore them clearly because we're very pleased to see what's happening with the cross rate with the US, and we'll be very keen to see whether the Federal Reserve or the FOMC move in June or not. But we tend to look at the trade-weighted index and look at that in terms of whether we believe it's at a sustainable or justifiable level.
The government has a number of pay negotiations with parts of the public sector this year. Would you be looking to the government to set the example in terms of those wage expectations you mentioned that are going to be so critical?
You know, it's probably more a question for the Treasury in terms of the budget outlook. I mean, we'll look at what sort of wage outcomes are occurring in the economy. The labour cost index has, I think, increased by 1.8% over the last year. Now, that's basically what do people in the same job without any productivity increase, what is the sort of pay that they're getting? And that's running at around 1.8. So we look at wage pressures across the economy as a whole in general.
This investor category that you've talked about before down here, the investor category, it's been suggested that this is not a tool in your box, and that's by Burl, and they say it's more of a political decision rather than a Reserve Bank decision. What do you see?
No, I don't see that. I mean, we think we're on very solid prudential grounds in terms of thinking about the asset category at which this sort of lending should be placed in. And in essence, we really want to get the financial services sector consultation and feedback about how best to define what an investor-related lending is. It's a decision that lies with the Reserve Bank, and it basically would bring us into line with the Basel standards.
But the consultation document does have this language about this being partly to facilitate a macro-prudential move against property investors, should that become necessary. Aren't you really identifying the target for the next LVR type intervention in the housing market that addresses the volumes of lending? After all, they are 30% of the new lending.
Yeah, they're about 35%. Investor lending is about 35% of bank lending across the country. It's about 40% in Auckland at this point. No, we wanted to indicate that, look, we are thinking about macro-prudential measures. As I say, there are no decisions. The fact that if we can move on this, what we think is an appropriate micro-prudential setting and get a clean definition for everybody, essentially, about what investor-related lending is, then it may create better clarity for us in thinking about if we were to introduce a macro-prudential measure, then we'd have a cleaner basis to operate from.
How important is the potential for a sectoral capital overlay or a counter-cyclical capital buffer, using those tools as well as or instead of the ones you've talked about so far?
I mean, different tools have different impacts. I mean, if you look at some potential measures, then they would affect the demand for that particular type of lending more than others. Others, such as counter-cyclical capital buffers or risk weights in terms of overlays on risk weights, by and large will affect the amount of capital that needs to be put aside for that sort of lending. And to the extent that that's passed on to borrowers, then it will affect demand that way, but probably less directly than potentially some other measures. That is, if any measures were to be introduced.
How concerned might you be about those who argue that the potential for increased capital for rental property loans might increase costs for landlords and therefore increase rents and rent inflation, and or reduce landlords' ability to fund new house building and therefore restrict supply?
You know, it's difficult to say where the incidence of any regulation falls. I mean, that's true for taxation, it's true for any form of intervention. To what extent is passed on depends upon elasticities of demand and that sort of thing. But as I say, look, all this is premature. We're just having discussions internally about the Auckland housing market and about our macro-prudential settings as well. Let me just check if Grant wanted to add anything.
And on the outlook for inflation, how much of this low inflation do you think is structural rather than one-off things that you can look through?
John, did you want to?
I mean, posing interesting questions. I mean, by and large, we're seeing very low inflation because tradable inflation is low. So that is due to the exchange rate, has been due to the oil prices falling, feeding through to petrol prices. We've also seen, telecommunications prices fall. These are so there's a lot of sequences of one-offs. There's interesting questions, though, that, there's very low global inflation, and to what extent is that being transmitted to New Zealand via the exchange rate? And so these are all interesting questions we're watching. We think at the moment, because the economy is expanding above its potential, eventually inflation will come back to 2%. Now, you can see it will take some time, but it's probably appropriate that it takes that time rather than try and generate excess volatility in interest rates or the economy. Monetary policy can't act that fast.
Governor, how confident are you in your inflation models, given they have consistently overestimated inflation over the last few years?
Well, let me ask the chief economist and head modeller.
Yeah, all models are wrong. Let me start that straight away. There is no perfect model, and there will always be errors. And we've been watching this very carefully, and we talked about this in December. And clearly, the outcomes have been coming lower than we'd forecast, but that has been true of everybody in the market. And in fact, if anything, the Reserve Bank had been forecasting lower inflation than anybody else. And the important thing here is that will happen from time to time, and the PTA actually recognises that there will be variations in inflation. The important thing is to actually learn from that experience and see what's actually going on. And right now, the key focus is on it's been a relative price shift because of oil prices moving. That's the big thing. And as long as that doesn't have any overdue influence on price setting behaviour, inflation will steadily come back to 2%. But there's no guarantee here. That we have to be incredibly vigilant that we don't set in motion a big change in price setting behaviour, because that's something then the bank would have to lean against.
Governor, the Prime Minister said on Monday that he would cut you a little bit of slack in terms of the undershoot of the policy targets agreement. How much slack do you think you have, and do you feel any sort of pressure because of those comments?
I think, Bernard, you might have been the person asking the Prime Minister, so let's turn full circle, huh? Don't feel under any pressure in that sense. I've never had the Prime Minister say to me that you need to do this. He's always respected the independence of the institution. And we're comfortable with the forecast that we've presented today, but we've made it very clear that we will be looking very closely at the data, particularly around wage and price setting, particularly what's happening in the non-traded sector.
Just one more on, you mentioned in the monetary policy statement the new 10-year mortgage and there has been some concern about interest-only loans for landlords. What's your thoughts on how the banks are operating at the moment, given you also mentioned in your speech a few weeks ago that you were watching the bank's activities?
There's a lot of competition for lending, clearly, and we're seeing reductions in fixed-term rates. I think there's probably limits to how much further that process could go in terms of bank profitability objectives and the cost of, or their funding costs, if you like. But look, the duration of this market is very short. You know, we must have in terms of Macaulay duration, right, interest rate duration, must be one of the shortest amongst the advanced economies. The fact that, you know, at this point you only have 3% of mortgage holders have fixed rate mortgages for more than 3 years, for example. I think something like 55% of mortgages are either floating or maturing within the next 12 months. So we feel we still have a lot of bite through our monetary policy. Over time, I think it would be a good thing if we had longer maturities. I mean, over time, in general, as we develop, greater opportunity for borrowers and investors in terms of the capital markets.
And just finally, are you concerned that the quantitative easing programs around the world are flowing through into low fixed mortgage rates here and are a problem in the world of currencies? Some people talk about currency wars.
It's not a term I would use, and I don't think many central bankers would, but you know, there's clearly been a lot of currency adjustment, and there are very substantial distortions created by quantitative easing. I mean, at this point, you've had something like $7 trillion US dollars of quantitative easing, and it's expected that this year it'll be the highest since any year since 2011. You've just seen the European Central Bank start its program of quantitative easing of 60 billion euro a month, and that's already had quite a significant effect on 10-year bond rates in Europe. I mean, you just look at 10-year German bond rates, they're around about 0.2 at this point. The French and Belgian rates are about 0.4, 0.45 or thereabouts. And you're starting to see the euro slide quite a bit against the US dollar. Now that reflects two things. It reflects things about expectations about tightening in the Federal Reserve and whether that'll be June or in the period June to September. But it also reflects the enormous activity starting to get underway by the European central banks. And one corollary of all this is that it completely distorts credit spreads. Completely distorts credit spreads. You know, you look at Ireland's 10-year borrowing rate, if you like, or yield on government securities. Look at Ireland's debt level. Look at its performance relative to New Zealand in recent years, and look at its current yields. I mean, it's a corollary of quantitative easing.
Just looking at your combination of your TWI forecast and your comments about the exchange rate and unsustainable, unjustified, and it needs to fall. But when we look at your TWI forecast, you don't really expect it to fall, do you?
Well, I'll hand over to John in a tick, but, you know, the assumption we make about the exchange rate is very much a technical assumption. We have, basically in our modelling process, we have a degree of mean reversion taking place in terms of the exchange rate. We make judgments about the speed of that mean reversion. You know, other forecasters like the IMF or the OECD, given that it's just so hard to make any projections about the exchange rate, it's often a random walk in terms of, you know, economists' projections. they either just assume a fixed nominal exchange rate or a fixed real exchange rate. They just make a technical assumption. So we have a sort of technical assumption about the degree of, about mean reversion. We vary the degree of it, but let me see if John wants to add anything.
I mean, the important thing to remember right now is lots of other central banks around the world are cutting interest rates, and that's the environment. And so we have to take that into account when we're thinking about the projections on the TWI, and that is a reality. But that said, if we see the TWI follow the track that we have, if you follow through on the forecast, you see the current account continue to expand, and it goes well above 5%. And the result of that is New Zealand starts to take on more and more liabilities. That is an unsustainable position.
Okay, sorry, second question. And this is about the 90-day rate. And you've got that, you've radically flattened that to 3.7 throughout the forecast period. Two questions around this. One is, you've shortened the forecast period by a year. Is that because of uncertainties around this? Second one is, if that 90-day rate is, quite radically lower than what you were expecting, given that area's impact on mortgage rates and what we see happening in the Auckland market, doesn't this put a bit more urgency around any macro and micro-prudential measures in that area?
In normal times, it's hard to talk about normal times, I guess, in these days of unconventional monetary policy. But in a normal business cycle, the ability of central banks to forecast interest rates accurately is probably limited to about 3 months and 6 months at the very most. Now, that's because all sorts of things are affecting interest rates in terms of offshore developments, domestic shocks of various times. All sorts of things affect interest rates. So, our ability, we try and be as transparent as possible. We're one of the most transparent central banks in terms of putting out interest rate projections. But our degree or our ability to forecast rates, the further out we go, just diminishes. In the past, we've sometimes used a fan chart, fan chart. But so that's essentially the reason. On the second question, we will do whatever we think appropriate in terms of our monetary policy settings, and I've said the sorts of indicators that we'll look at. In terms of Auckland house prices, they haven't been a factor in the way we've set monetary policy at this point in time. And we are thinking about, should we introduce any macro-prudential measures? We're just doing some analysis on that, but we haven't made any decisions. What we have done is move ahead on this micro-prudential front, where we're doing so for sound prudential reasons. Yeah, Brian.
The statement talks about a growth rate of 6 to 7% in China. How much of a downside risk for New Zealand do you see in that sort of a slowdown to that extent?
Well, China has sort of probably been growing at around 7 to 7.5% or so, as best anyone can tell, over the last 18 months. They've officially reduced their forecast down to 7% for next year. We follow as best we can what's happening with property prices in China, partly for two reasons, partly because of the timber exports, the log exports that go there, but also we want to know what's happening in terms of aggregate demand and the impact potentially through on dairy prices and things. As best we can tell, prices have stabilised, house prices in the Tier 1 cities and the main cities like Shanghai and Beijing and Wuhan and some of the other big cities. But there still seem to be some softness in the Tier 2, Tier 3 and Tier 4 cities. I don't think anyone, not in this institution, is sort of thinking that China's growth is going to slow to 4 or 5%. We don't see that.
Are you saying that if
wage expectations start to drop in light of the zero inflation that you're targeting, at that point, if that beds in, you'll start cutting. Is that essentially what you'd work against that?
Well, we're not targeting zero inflation as point number one.
If that was to be structural, then there was a change down in expectations between consumers and businesses, that's when you would start to move.
Well, if you saw, put it this way, we've got the OCR at 3.5%. The economy is doing tremendously well in many regards compared to overseas countries. We have the luxury of having the ability to lower rates substantially if we need to over time, and that's something that most other advanced economies don't have that ability to do that. What we would do if inflation expectations or if wage and price setting behaviour started to come at a different level, if you like, than what we were projecting or expecting, and we believe that that's something that's likely to be there for a period of time, then we'd need to think very carefully about that in terms of monetary policy and interest rate settings, and one could see if that were to be continued, one would want to make monetary policy adjustments.
So what's the message to businesses and workers? Are you telling them that they should continue to push for 1.82%?
Well, John, let me...
I mean, going back to your answer, I think most sensible advice, if you've got lower and lower structural change in price setting behaviour, is monetary policy should be easier in those circumstances. That is the standard monetary policy response. And then to your second question, we wouldn't actually offer particular advice to those price setting, businesses or people. But if they set prices at 2%, we said that's our target, and we probably got our monetary policy settings correct. If they change that behaviour, we just say, we're going to have to make some adjustments to make it happen. And it goes to the interest rates that we have in our forecasts. I would actually say those interest rates, I never view them as actual forecasts. They're our plans that is necessary to make inflation come out towards target in about 2 to 3 years' time. And that's why we've shown at this point 2 years, because that's the relevant planning horizon. Beyond that, those interest rates will affect inflation 4 and 5 years out, and that at this point is not that relevant at all.
Just to clarify one thing on the Auckland housing market, are you saying that it's not a concern for consumer price inflation, what's happening in the Auckland housing market, and therefore, if there hadn't been another surge in Auckland, that wouldn't have allowed you to cut interest rates?
Well, I think what we're saying is our concerns about the Auckland housing market are in terms of financial stability, and that's one of the things that the Reserve Bank is required to think about under legislation. The point I was making earlier is that, if you looked at what happened over the period 2003 to 2007, we had the most rapid house price inflation of all the countries in the OECD, and there was particularly sharp appreciation as we moved towards the end of that period, and that was spilling over, those wealth effects were spilling over into consumption and creating more inflation pressure. And at that time we had interest rates very high, trying to lean against it. That in turn was creating upward pressure on the exchange rate, and the level of real interest rates at that time was very high. We're not seeing those sorts of transmission effects going from wealth into consumption into inflation pressure at this point.
Governor, currency markets seem to have responded with about a 0.5% against the US gain against the Kiwi. Have they misinterpreted your statement?
I wouldn't make comment on that. There's lots of things that move the exchange rate. Let's see what happens over time. Well, thanks very much indeed.